the repo blowout is an inconvenience for the Fed. They're trying to address the problem, but an inconvenience can turn into a much bigger problem if it causes a failure somewhere in the financial system. And at the moment, what they're doing is they're putting sticking plaster on the cracks. Now, something's got to force their hand, and I think that they can't go back into the markets in size unless there is a serious disruption. Now, it's my contention that if you start to see high debt liquidity ratios, it's more difficult to refinance your debt, and hence you get a financial crisis, and every financial crisis has been a refinancing crisis. If you start to see problems in the repo collateral side, it's going to pose a problem ultimately for refinancing.
Welcome to the Macroscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. Welcome to the Macroscopic Podcast. Last time Michael joined me, we discussed what he called the real battle of our age, the global capital war between the US and China, not fought through trade tariffs, but through liquidity and collateral. He warned that the world was heading into a refinancing wall between 2025 and 2028, that the Fed's balance sheet tightening was madness, and that China was quietly devaluing its paper yuan against gold to escape its debt trap. Fast forward to today, the Fed has just executed $30 billion worth of overnight repos, the largest since 2019. And Michael's last piece, the return of not QE, suggests the central bank is already being forced back into liquidity support. So in this conversation, we'll unpack what that means. Is the Fed already back into that QE in disguise? And what this tells us about the health of the global financial system and how this liquidity war between East and West is evolving. Michael, as always, it's a pleasure to welcome you back.
Well, very good to be here. Lots to talk about, and I hope I can do a good job because these are big topics.
Big topics indeed. And we'll take them one by one. And so my first question would be to what I alluded already. And this one has to refer to the overnight repos that the Fed executed a few days ago, on Friday, if I'm not mistaken, of the $30 billion in overnight repos. And as I mentioned, this was the biggest since 2019. You've said in the last conversation that there was repo market tension to be expected as liquidity stress factors. Is this, you would say, the first crack in the system that you warned us about?
Yes, I mean, I think that's pretty straightforward. It is. What we're seeing is liquidity conditions are tightening, particularly in the US markets. I mean, that in many ways is a deliberate policy choice. I mean, they've pushed themselves or traveled down that road deliberately. And the reason being is that they've allowed bank reserves, which is a number that the Federal Reserve controls absolutely, to shrink below $3 trillion. Now, that has been a policy objective for some time, because there's been a lot of disquiet, or let's say unhappiness, about the size of the Fed balance sheet, and particularly the amount of excess bank reserves, or supposedly excess bank reserves, that are in the system. Not only the Fed themselves are uncomfortable with that picture, but also the Treasury Secretary Bessent, and actually new appointee to the FOMC, Stephen Miran, have both independently said that carrying these high levels of reserves in the system is basically creating asset bubbles, and that's leading to, social problems, because it's creating a big divide between the haves and the have-nots in wealth terms across American society. And I get all that. The problem is that we are where we are, and we need liquidity in the system because the system has changed. It's no longer about new capital raising for investment projects. As the textbooks tell us, it's all about debt refinancing. And we've got such huge debts that we've taken on, particularly in the wake of the GFC And in particular as well, after COVID, those debts are enormous, but debt has to be refinanced. It has to be rolled over. And to roll over debt, you need balance sheet capacity among credit providers, in other words, banks or shadow banks, and that is liquidity. So without the liquidity base, you're going to get refinancing tensions. And how do those refinancing tensions express themselves? It's in the repo markets. And so what you're seeing is not only a jump in repo spreads, in other words, repo rates, which are market determined rates, are trading significantly above Fed funds rate. And I'll put a chart up in a moment for that. But what you've also got is stresses in the system that are forcing borrowers to the Federal Reserve's emergency financing window, which is no longer really the discount window as we're used to in textbooks, but it's something called the standing repo facility, which is a much broader conduit for liquidity to be injected in the system. As you rightly say, as of the 31st of October, they drew $30 billion out of that tranche. It's gone on because they've continued to draw. As of Monday, they drew a lot. They drew another, I think, close to 20 billion. So, I mean, these numbers are persisting, and the tensions keep on. At the moment, this is an inconvenience for the Federal Reserve. Let me stress that it's not. They're not that they're panicking is the wrong word. They're trying to address the problem. It's an inconvenience, but an inconvenience can turn into a much bigger problem if it causes a failure somewhere in the financial system. And what you're seeing in parallel is the number of trade fails among primary dealers. That means that a bond transaction, for example, can't take place. Either buyer or seller defaults on that transaction. The number of failed trades is increasing quite significantly. So this is what you'd expect. And so the next shoe to drop would be a jump in volatility in the markets. And then you start to see a more serious unwind of leverage positions. And as we know, hedge funds have got huge leverage because what they're doing, not just among general assets, but more specifically with treasuries, is they're doing leverage trades, what's called a basis trade, where they essentially buy cash bonds and they short futures. But this is a huge size. The Federal Reserve, which doesn't really know exactly what the hedge funds are doing, estimated that last year hedge funds bought a net $1.5 trillion of US treasuries, which makes them effectively the biggest buyers.
And you've also mentioned that you have a chart that also illustrates the spread. Would you maybe like to elaborate more about that?
Yeah, let me sort of go on to this. If you look at the slide that I put up, this is really a summary, if you like, of the modern financial system. And what it has at the heart is, in the center of that diagram, liquidity and debt boxes. Now, what that's trying to depict is that you've got this, if you like, nexus between debt and liquidity within the financial system. This is a refinancing system at heart. And the paradox that we've got is that debt needs liquidity for refinancing. Okay, I've just discussed that bit. So you need liquidity to roll over your debts, to refinance debts. And you also need debt for liquidity because today something like 80%, nearly 80% of all borrowing is collateralized in the world economy. In actual fact, if you look just to the left-hand side, you'll see the figure is actually 77%, which comes from the World Bank study. So virtually 80% of all lending today has collateral in some form, whether that's real estate collateral or whether that's treasury security collateral. The bulk of lending is collateralized. That is a radical change from what we saw before the global financial crisis, where probably the bulk of lending at that time was just done on trust. There wasn't collateral posted to this same extent. So that's how the world has changed. Now, that paradox between liquidity and debt, the fact that debt needs liquidity and liquidity needs debt, is why you get potentially instability in the system if one leg of that is derailed. And what you have is a refinancing leg on the right, where something like 70 to 80% of all transactions in financial markets, primary transactions, are debt refinancing transactions now. It's not about raising new capital for CapEx. Most of that is done where it's done is out of cash flow or from governments. It's not done through raising new money. The capital markets are serving a refinancing function fundamentally now. And then on the left-hand side, you see this repo collateral wing, which is basically converting debt into liquidity. And it's that which is really coming unstuck right now. But you can see, because this is a circle, if you start to see problems in the repo collateral side, it's going to pose a problem ultimately for refinancing. And you'll see things like bond spreads, credit spreads, term premium, et cetera, will start to widen out or present problems. So if you look at that repo collateral problem, that's really what we're facing on that left-hand side. Now, just before we get there, let me give the backdrop. This is the ratio between debt and liquidity in the world economy over the course of the last, 45, almost 50 years. And this is annual data, but it illustrates the point that what you have is this equilibrium between debt and liquidity. So this is the ratio for all advanced economies. And if you move up higher on that chart, saying that the ratio between debt and liquidity is deteriorating, there's more debt relative to liquidity. And what I've annotated on the chart are periods of financial crisis. Now, it's my contention that if you start to see high debt liquidity ratios, it's more difficult to refinance your debt, and hence you get a financial crisis. And every financial crisis has been a refinancing crisis in my book. If you go to the other side of that dividing line, which is drawn at about 2 times the dotted line, you get a lot of liquidity relative to debt. And what that's saying is, in those circumstances, there is excessive liquidity, and that excessive liquidity causes bubbles, asset bubbles. And we've seen a number. The latest iteration of that, which really occurred in the wake of the global financial crisis, is the everything bubble, which has lifted asset markets hugely. That had another big leg down after COVID. And you can see, relative to history on that chart, that we've been in a hugely luxurious position as regards asset market liquidity. That's what's propelled the everything bubble, if you like. Now, what you can see on that chart is the orange line is starting to rise. And that orange line is slated to go above the dotted line sometime in the next 2 years. The reason that's happening is really twofold. One is that liquidity conditions, or the supply of liquidity that's coming from the central banks, is slowing down. Okay, that's number one. I'm not saying it's contracting, but the rate of growth is slowing. And the second thing is that you've got a lot of refinancing coming onto the market. Now, let me just show that. And you can see it in this chart, which is looking at the annual debt roll that we in the world economy have to face every year. Now, this is showing all forms of new debt, or all forms of debt that is coming back to the market. This is the increment. So this is not the level. This is the change every year. So what it's saying, for example, in year 2000, year 2020, you saw 3.5 trillion of extra debt to refinance. But in 2021 and 22, you saw a net decline in refinancings. And that was because policymakers enacted a policy of zero interest rates, or near zero interest rates. If you have zero interest rates, you not only incentivize more debt take up, but you actually encourage people to refinance their debt and push it out into later years. In other words, a terming out of debt, as it's called. That terming out pushed debt back into the latter years of this decade in 26, 27, 28, 29. And you can see what we've done here is to show that incremental increase in financings that are coming through over the next few years. So this big wedge of extra debt has to be refinanced with extra balance sheet. And so the monetary authorities, not just the Fed, but the ECB, the Bank of Japan, etc., have to supply more liquidity into the system. So their financial markets will leverage that up or create enough balance sheet capacity to actually refinance the debt. Now, if you don't do that, you get a problem, and the problem is a refinancing problem. And you can see in this chart what's happening in the US. Now, this chart is probably now about 3 or 4 days old, so I haven't put the Friday or the Monday plots in, but they are equally jumpy. In other words, they exceed that previous peak, the peak you've just seen. And what that's saying is that there is a differential, a positive differential between SOFR rates, which are rates for repo, and Fed funds targets. Now, what you would normally expect to see in the markets is actually SOFR trading at a small discount to Fed funds, because SOFR is a collateralized rate, whereas Fed funds is uncollateralized. It's only based on trust. And therefore, you'd expect that SOFR is safer in that sense, and it would be at a small discount, which you did actually see basically in 2021-22. What you've got now is a backdrop which is saying that now we've seen elevated levels of that spread. You've basically got something like at least 20 basis points above Fed funds. So in other words, that the quarter point rate cut that the Fed put in the other day has now been eliminated. The markets are pricing in higher rates. And that's caused because of shortages of liquidity within the system. And that is the problem.
So just to resume it, and since also like last time we talked, the overall level of liquidity is then also decelerating in that sense. And we're entering then a more risk-off period. Are we still in that period?
In terms of where we are today as we speak, our liquidity indexes are still expanding. Okay, so on our view, we're still invested in the markets. Okay, but we're getting nervous because prospectively, what you're going to start to see is a deterioration in liquidity. And let me just explain that in two ways. First of all, if I'm going to go back in the presentation to an earlier slide, but if you look at this earlier slide here, what it shows is a very long-term view of the global liquidity cycle. Now, this is, as I emphasized, a refinancing cycle. It has a frequency of, as you can see there, 65 months, and we put a sine wave on top of that. That sine wave we estimated back in year 2000. So what you see thereafter for the last 25 years has actually been just extrapolation of that straightforward 65-month cycle. So what you see is what you get, and that shows how well or badly it's been doing. And the cycle has always been slated to peak sometime in late 2025, early 26. Now, is this current blip down the turning point? I'm not 100% sure of that, but what I do know is we're losing momentum and the cycle is becoming choppier. I suspect this, or I fear, I should say, this may be the turning point because of what we're seeing in parallel in the SOFR or repo markets. But you can see here that the cycle neatly bottomed in October of 22, and we've had something like 35, 36 months of an upswing. And if you look at the following chart, what we show here is that particular progress. So the red line is the current cycle, the current liquidity cycle. The dotted line is the average cycle that we experienced really from or through that period of the 1970 to 2025. So that long period of 55 years is averaged in the dotted line. And you can see that the cycle is not dissimilar currently to that average. And what we'd expect is something like a sort of we're sort of burning out now. In other words, you'd expect some sort of inflection. It's not guaranteed, but that's what we're looking at. So that's our fear going forward. Now, if we look at latest data, we can see some of the signs of deterioration. And we've got to build this picture up. So first of all, you've got the SOFR spread blowout. That's saying that liquidity is tightening. Secondly, you've got this chart, which is looking at the prospective growth of Fed liquidity. Now, this is assuming that the Federal Reserve stops QT. It is not assuming that they restart QE, okay? So that's the proviso. And they're hinting that they may have to. And this evidence, in other words, the SOFR spread blowout and the borrowing on the standing repo facility are suggesting they're going to have to restart quite quickly. And this chart is illustrating that if they continue their current policy, you're going to see Fed liquidity, which is the amount of money that the Federal Reserve itself injects into markets, is going to actually fall in absolute terms through 2026. And technically, the reason for that is broadly that areas of stimulus have evaporated. So one of the, again, this is slightly jargonized or wonkish, but there was a facility that the Fed had on its balance sheet called reverse repos, that it was, if you like, a account of excess liquidity that the markets held on the Fed balance sheet. That has now been dissipated. That's been thrown back into the markets. So they can't ease through that mechanism. They could ease through doing repos, but that's I think that's a dangerous policy for a number of reasons, and so they're going to have to start buying treasuries again. Now they've hinted, and in factual fact, there was an interview. I beg, but not an interview. There was a report in the Financial Times of supposedly an interview with Fed officials after the last FOMC, where rather remarkably the figure of 20 billion of buying of treasury bonds was aired in the piece. This is a monthly purchase. Now that wasn't plucked out of nowhere. The journalist didn't make that up. That must have been planted by a Fed official to suggest that they were on course to start purchases of treasuries again of that magnitude, which is about 250 billion a year, so $250 billion. So that's the sort of magnitude we're looking at. If they do that, they'll probably allow the Fed balance sheet or the Fed liquidity here to flatline through next year. So there won't be a collapse, but it'll be a flatlining. It won't be a lot of growth. The reason it won't be a lot of growth is that you need liquidity just to satisfy the needs of the economy through cash in circulation. So that's, if you like, taking liquidity out of the system every year because we need more notes and coins in the system. So that may be technical, but the fact is that what we're looking at is a flatlining of Fed liquidity. And everything that the Fed is telling us right now, even though it sounds optimistic, is consistent with a market that's range bound, not a market that's going up. And that's probably the bottom line.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. You've also estimated that there's a 400 billion reserve shortfall. Is that something that they would then play on catch-up on in that phase?
Yeah, I mean, you can let me illustrate that. So if you look at this, chart, what it's saying is that this is notional bank reserves, shown in orange, in the system, projected out to the end of 2026 with that dotted line. The red dotted line are my estimates of what are called adequate reserves in the system. Let's take that to mean minimal reserves. In other words, what the banks need as a minimum to work with. And if they don't get that, they're going to have to go back to the repo markets and start bidding for more funds. And as they bid for more funds, repo spreads go up. So the dotted red line is the equilibrium point where we're back in line and there's no stresses in repo markets. At the moment, we have a level of bank reserves at about $3 trillion. So my estimates of adequate reserves are about 3.3. Okay. And just for the record, I've estimated that looking at the recent history of the repo markets and identifying stress points and saying when you start to get a stress, that's saying that reserves are short. So when you get no stresses, that's telling us what the adequate level of reserves is. So that's how I've estimated that. Now, the Federal Reserve itself has magicked up a figure of 2.7 trillion which they think are minimum levels of reserves or adequate levels of reserves for US banks. I don't know how they got that figure, apart from saying, well, it's a nice round number as a percent of GDP, and therefore that's what they're going to run with. But I think that's, I don't think there's any particular logic in that derivation. What I've done is to look at where you actually get stress, and therefore the shortfall between their estimates and mine is 600 billion, and where we are right now and where we're prospectively going on the dotted line, assuming an end to QT, I remark, we're going down to about 2.8 trillion. So slightly above the Fed's estimate of minimum, but still way short of mine. So that's the shortfall that I'm talking about, that what they're going to have to do is to put something like 400 to 500 billion back, at least back into the markets to actually get back to that equilibrium. Now, what we know is that something like 150 billion will be taken out anyway through needs of cash in circulation. So that's a draw on that liquidity. So in actual fact, if they put 400 back, you're only going to get a net 250 working. So they're still going to be short. And the sort of figure they're talking about right now is about 250 billion, but they may be able to squeeze 150 billion out of the Treasury General account. So, what I'm saying is we're still short. You're not back to an abundant liquidity situation.
And you also noted that there's a bit of a dysfunctioning based on the TGA as well because of the government shutdown, and this also has an effect on that precisely or not?
Yeah, I mean that's a very short term. Well, I ought to not say that because the government shutdown's gone on for rather longer than
Who
most
knows?
people thought. But who knows? But let's say that it's a temporary problem, and what it's done is it's pushed the Treasury General account is an account that the Treasury is an operating account the Treasury holds at the Federal Reserve, and it's used for sort of day-to-day payments. And the level that they've typically, or the level they want, is about $850 billion of reserve on that account. That historically is quite high. It's been pushed to a high level largely because of the change in the issuance calendar. So they're doing a lot of issuance at the front end of the market. And because they have to be quite fleet of foot when they're issuing bills, very opportunistic, they need a bigger cushion. So that cushion has been extended. It used to be probably about nearer 200, 250 billion or so. So it's been pushed right out to 850. So they've got sort of a working margin of error there. So there's a little bit of flexibility. But at the moment, the TGA is about $1 trillion. So they could easily push it down even to get an 850 target of 150. So there's some leeway there. But at the moment, you're absolutely right. The government shutdown is causing the TGA to be bloated. That's for sure. It's taking liquidity out of the system now.
So if we now go back to the 2019 style repo crisis, possibility, could the Fed even stop this in time without any political backlash if it really reaches concerning levels?
Well, as I said, at the moment, the issue is that the repo blowout is an inconvenience for the Fed. It's it may be flashing an amber traffic light. It's not giving anything more than that, but they know that they're short on liquidity, and they've got to find ways of putting it in. Now, the question really is, and it's much more a philosophical one, is that do they go the whole hog and say, well, okay, let's tear up the script of saying that the minimum level of reserves is 2.7 trillion. Let's completely rethink this, or can we sort of we can just put sticking plaster on the cracks. And at the moment, what they're doing is they're putting sticking plaster on the cracks. Now, something's got to force their hand. And I think that they can't go back into the markets in size unless there is a serious disruption. That would be my view, because I think it's politically difficult to do that. And therefore, you may have to see some disruption, whether it's a major failure or another more serious credit default than the ones we've had in the last few weeks. That may be the trigger, and that may allow them then to say, without loss of face, we're going to start buying treasuries because markets need that extra liquidity. So I think you're going to see disruption before you see good news. I mean, ultimately, what we're looking at here is a situation which ultimately says bad news is good news, because we're in a world where debt has to be refinanced. And you simply cannot default debt on the scale that is implied here, because debt backs the financial system. As I said to you, that liquidity in the system is collateral backed, and a lot of that collateral is debt. So you simply can't have mass defaults. You've got to you've got to have the liquidity there to prevent that, and that will be a bailout. So the Federal Reserve is there and poised to inject liquidity, as it's done many times before. And that's the world, unfortunately, we're in. That's the fact. So you could argue that bad news is good. So if you do see a financial crisis and a major sell-off, then you've got to buy back, buy the dip, because that's what's always worked, because we know the federal authorities are going to come back, and others. And the Federal Reserve leads for the world. So what you see the Fed doing, the ECB is going to have to copy. There's no question about that. And that's what we're doing. The only question is, I think, is how much liquidity they put in. They put enough in. Do they put enough in to stabilize markets, or do they put more? Do they put more in, which actually creates a further bullish up leg? Now, my view is I think policy has changed, and I think policy is trying desperately to get to this level where they don't. They're sort of betwixt and between. So they're keeping the market stable, but they're not really pushing Wall Street up dramatically higher. And one way to look at that is, and maybe I can just show you this chart en route. This is just showing the impact and why this is so important, because this is illustrating Fed liquidity. Fed liquidity is the other side of bank reserves. So if Fed liquidity increases, bank reserves increase. If Fed liquidity contracts, bank reserves contract. And this is the mechanism by which the Fed controls bank reserves. Now, if you look at Fed liquidity in red, you can see there what I've done is traced out over time, going right back to the early 2000s, the history of Fed liquidity. And what I've also put on the chart is a projection into the end of 26. So that's what is slated to happen on the assumption that QT ends, but there is no restart to QE yet. So I haven't put the optimistic case in. And the orange line is the S&P 500, but I've lagged it by effectively 6 months, 25 weeks, to show as best I can when you see big drawdowns in Fed liquidity, what it tends to do to the market. So it tends to create market volatility or sell-offs within about 6 months. And that's what you basically get. And in response to the question, which is inevitable, what happened before 2008? Well, we were in a different financial system after all before 2008. And it was the shadow banks in particular that were really driving a lot of the liquidity creation, not the Federal Reserve. And that was a shadow banking boom and bust. And what we're now in is a world where we're talking about QE, QT booms and busts. And that's all about the Fed balance sheet. So that's the danger that we're looking at in terms of this chart. So you need liquidity. Now, when I said that we're in a situation where you may not get a lot of liquidity, you'll get just enough. So the Fed is searching out for a Goldilocks scenario here, neither too hot nor too cold, in other words. What this chart is basically demonstrating is how the system is evolving, in my view. And that leads on to this whole question about China, what China's doing, and maybe this capital war episode in the sort of longer term. What we're looking at here is all forms of stimulus that the US economy enjoys from the Federal Reserve and from the US Treasury. Now, the first thing to say is that the Federal Reserve can stimulate through traditional means, in other words, through pumping liquidity into markets via buying Treasury securities, okay, or what's called open market operations. Or it can create liquidity in another way, if you like, sous la table, in a hidden way, which is doing things like the reverse repo account, letting that run down, through spending more money on the Treasury General account, through its operating losses, which is feeding money back into the system, which is currently a source of liquidity. Or as well, it can basically do it through things like this special programs like the Bank Term Funding Program or the Standing Repo Facility. So these are other mechanisms they can use. The red is traditional QE, in other words, balance sheet expansion through buying treasuries. The orange is the not QE, these other forms, Standing Repo Facility, bank term funding program, etc. The black is what I've called Treasury QE. Now, Treasury QE is slightly wonkish, but it basically says, look, one of the ways that you can increase liquidity in the system is to inject money via Treasury bills. The reason that's a liquidity injection or equivalent to one is that it changes the duration or the average maturity of debt or assets held by the private sector. So, in other words, if the US Treasury normally issues 30-year debt, and instead it says we're not going to issue any more 30-year debt, we're going to issue 3-month Treasury bills, the change in the average maturity of their debt issuance is going to provide a lot more liquidity to the system. Because if you're a bank or a finance institution, by definition, a 30-year Treasury will take up a lot more balance sheet space because it's a more volatile instrument than a very short-term 3-month Treasury bill. What's more, banks tend to buy Treasury bills with alacrity, and if a bank buys a Treasury bill, that's pure monetization. So that's the other route towards liquidity. Bit more wonkish, but that's a very valid conduit. Now, what you see here in the chart is the history over the last few years, and the black area is becoming more dominant. In other words, it's Scott Bessent, not Jay Powell, who is the source of liquidity in the future. And the reason that's an important point is that what you can see here are two things evolving. One is that there's a cycle in these liquidity impulses. And if you look at where we are in 2025, we've just come out of the low point in that liquidity stimulus. So actually, I think no surprise the US economy is cooling a bit, but it could well accelerate into 2026, contrary to what most economists are saying. And that's because you're getting this extra stimulus. Second point is, how is Scott Bessent doing this? Because what he's doing is spending a lot of money for the government in the real economy, doing things like more defense procurement, more strategic alignments, more strategic mineral purchases, etc. He's paying for it with government money, and that government money is coming through the bill market through this funding. And therefore, what you're getting is this Treasury QE, which is effectively driving the economy. The important point here, and the point that Bessent makes, I think with a lot of validity, is that if you're spending money via the Treasury, it's very directed spending, and it is going into the real economy. We can debate whether that creates inflation in the long term or not, long into the night, but effectively that's what they're doing. If you leave it to the Fed has a very broad hose, and the Fed sort of splashes money everywhere and everybody gets soaked. But asset prices tend to go up. So it's very sort of ill-directed Fed liquidity. Treasury liquidity is very directed. And that's the difference. If we move from Fed QE to Treasury QE, it probably hurts Wall Street, but it benefits Main Street. And that's what I think the difference is. And that transition, which we're seeing now, is very difficult to fine-tune, which is why we're seeing problems in the repo markets. That's the bottom line. Now, you may have some questions on that, but the corollary now is the Treasury QE, how it's financed, and the role of stablecoin, which could be big.
That was actually my next question. And I want to see, because a lot of experts online, some really diss it as one of the, let's say, milkshake dollar theory type of narratives where you can back up treasuries, especially the short-dated ones, with the whole ecosystem of stablecoins. The Genius Act got passed also to enable that and to put some legislative frameworks around that. How much importance do you really think it might actually make a dent? The Tether, for example, has been one of the biggest purchases of treasuries recently. Do you think that this will really make a big difference in that sense?
I think it could do, and I think I think the jury is out, but I think the prospect is there. And what this really comes down to is the effect not stablecoin on the domestic US economy, but much more on the international economy and the funding that this could unlock for the US government. Now, already the ECB has said, well, this looks unfair to us. US stablecoin could be a threat to the European monetary system because we would lose control over monetary policy in the Eurozone. And I think that's a realistic threat. Now, it may well be that we're debating the degree. Maybe it's a grey area. Maybe the ECB loses control of 10, 15%, maybe more percentage of deposits, but it still could be a meaningful amount because European residents could think, well, okay, if we put money into stable US dollar stablecoin, potentially it's anonymous, or it gives us one line of defense here. It may be that we can hide it from the tax authority more easily. I'm just supposing the arguments that people would present, or at least it's outside of jurisdiction, European jurisdiction, and we feel more comfortable holding US dollar assets in this form rather than a bank. And again, I'm just proposing arguments that could be made here. That could be the incentive. And it isn't necessarily the case that these stablecoins do not pay interest or do not pay an income, because they could basically, as is being mooted already, give a fee rebate, so-called fee rebate, which gets around the legislation of paying interest. Although, as I understand it, the inability to pay interest is only for US residents, not for foreign residents, but that's a detail. But the bigger thread is not for Europe, it's for the rest of the world, because Europe has the euro, which is at least a decent and viable currency with some integrity. Once you start thinking about African currencies or Latin American currencies or other international currencies, then you start thinking, well, actually, the residents in these countries already hold dollars. They're constrained by the lack of paper supply. If they've not got access to stablecoin, they're going to move with alacrity and size into the stablecoin market. And that would mean that effectively the world dollarizes very quickly. Now, I wouldn't rule that out as a possibility because I think it's very realistic. And I think it's particularly a threat to China. Because what we know is that if, for example, hypothetically, you took capital controls off of China, what would be the direction of capital? It would leave in big size, in my estimation, okay? Now, if you start to think this through, and you've got a situation whereby Chinese exporters already got a lot of dollar deposits, they're feeling slightly uncomfortable given the precedent about the sequestration of Russian assets after the invasion of Ukraine, holding it in Western banks, whether it be European or US banks, they feel uncomfortable about that. They can hold it in stable coin. And it's a lot easier to open a stable coin account than it is now to open a bank account. So that could be done. And there is some degree of anonymity in holding those stable coin. I'm not going to say exact, but there is at least some degree of anonymity that could cause them to shelter that. And I think from a Chinese exporter's point of view, if you've got a lot potentially of dollar revenues, and even despite the tariffs that have been imposed, China's trade surplus in dollars has gone up, not down. So think that one through. So they've got to have somewhere to put those dollars, and stablecoin could be the answer. And we could be talking about a huge size of inflow. The Chinese authorities are worried. They're worried simply because they would lose control of the Chinese monetary system. There is a discouragement, from the point of view of a Chinese exporter, or there's a, it's a choice between what they call the devil and the deep blue sea. Do you put it back into the Chinese banking system, put your money back, convert it back into yuan, and hold it in the Chinese banking system? Probably not, because then you could get that sequestrated if you behave like Jack Ma and become persona non grata. So that is ruled out. So stablecoin are the obvious answer. And I think that's what China is panicking about. And what you've seen in China this year is a very significant change, which I'm about to show you. Sorry, that's this chart. And this is showing People's Bank of China's liquidity injections into the system. Now, I think this has spurred China. Anecdotally, but unofficial anecdote would suggest that policymakers are running scared. And what they're doing now is they're trying to shore up the Chinese financial system and to get out of the debt burden, which is really impairing it. China has a huge debt problem, as we know, that is creating deflation in the system. The only way you can, or there are two ways you can get out of debt, I should say. One is to default. But as I've tried to argue, you can't default in a modern financial system because effectively liquidity or credit is debt. So everything is sort of rests on everything else. So you simply can't default unless you want to end your financial system and your economic control. So they can't default. Second option is to print money and devalue it. And that's what they're doing here. So they're trying to dig themselves out of this debt grave by printing lots of money. And let's just see this chart here, which is looking at the debt liquidity ratios between Japan and China. Now, Japan has managed to get itself out of its debt problem to an extent. The black line is looking at the debt liquidity ratio of Japan. I look here at debt liquidity, not debt GDP. A lot of economists look at debt GDP. I'm not sure why. I don't know what it really tells you, apart from the fact that number is going up. But debt liquidity is a meaningful statistic because it mean reverts and it shows the ability to refinance debt. And what you can see in the period from about 2000 through 2010, Japan's debt liquidity ratio was sky high. That was impairing the economy. The economic performance was a big drag on Japan's economy. And what they've done through Abenomics and through the purchases of JGBs by the Bank of Japan, what's happened is that debt burden has come down. They've basically inflated their debt away, and you can see the debt liquidity ratio dropping back. Liquidity has been created in size, and the yen has devalued dramatically. Okay, that's the story. Look at China, the orange line. China is about 10, 15 years behind Japan. And what it's trying to do now is exactly the same thing. So what you're seeing is the Chinese yuan devaluing. But as I've said before, don't necessarily look at the yuan US dollar cross as your marker here, your benchmark. Think about the yuan gold price. And I've tried to show this in this chart, which is always out of date because the line moves up and down so dramatically. But this is really trying to show what the Chinese have been doing. And it's no mistake that the Chinese are actually buying gold as well, because it's simultaneously shoring up their financial system and giving them some cushion against this devaluation. But what they're doing is they're trying to reduce rather the nominal value or nominal impact of Chinese debt, particularly real estate debt. So what you've got to do is to devalue your paper assets, i.e. the yuan, against real assets, i.e. real estate or gold, and that's what they're successfully doing. And that is basically the background to the Chinese monetary system. And what you've got basically going on in the world economy, big picture, is you've got a bifurcation of the world monetary system into two, if you like, subsystems. One is a US system that is backed by treasuries, but those treasuries are wrapped in stablecoin. Okay, so effectively it's a digital collateral, if you like. And then what you've got in China is a paper yuan system that is increasingly backed by gold. And therefore, you've got a gold-backed or quasi-gold-backed system in China. So you've got two ultimate collaterals. You might say digital assets for America, re-Bitcoin, and gold in China. And therefore, we've got to start thinking seriously about diversifying into those two assets, not as alternatives, but as complements. You want gold and you want Bitcoin. You don't want one or the other. And that's really the story.
So that actually already answered my follow-up question about the role of the yuan and gold. And then I was also wondering, since the West, and we'll just like resume it very simply with the G7, who hold about, I think more than 50% of gold reserve worldwide officially, wouldn't they also be keen or interested to follow suit and devalue paper against the gold that they like ways of offsetting the debt as well?
Well, I wouldn't necessarily rule that out. And I think that what I'm suggesting here is a sort of polarization of the system into these two assets. And I think you could legitimately argue there'll be shades of gray. But then I could say that if this is a competitive situation, a capital war, and we've stressed the idea that, the trade war, I'm not going to dismiss it as being unimportant, but it really is the veneer on top. And what you've got to think about is what we're really fighting is a capital war. It's a battle for the control of capital in the world economy, not about trade patterns. It's about ultimately capital. And China wants its capital to be in control. America wants its capital to be in control. and that is really, if you like, the vent is currency, or you can think of it in currency terms, I should say. So if you want to undermine the US dollar with its digital collateral, what China's got to do is to try and undermine the integrity of a digital coin, and that may be attacking a blockchain system, or it may be, it may be trying to do cyber threats, whatever. Because the more disruptive you are in digital technology, the less comfortable people may be holding these digital assets. So, the advent of quantum computing and the advances China is making in that sphere are probably ultimately a threat to the dollar-based monetary system looking into the future. Equally, America will then think, well, okay, it's in our interest if China is backing things with gold, or it's got a lot of gold. We don't want the gold price to go up because it's giving China more power. So what they really want to do is to, if you like, stabilize or reduce the gold price. So what I'm saying is, I don't know who's going to win this battle, but you're likely to get a lot of volatility on both those two asset classes. They may trend higher in the long term. They should do, because we're in a fiat world, and those are basically collateral hedges. But you're going to get volatility between these two areas, as sometimes the US is in control and sometimes China's in control. But the one thing that you won't get, I absolutely guarantee, is a return to a gold standard. And some people are arguing that this move by China to accumulate gold is a return to a gold standard. It definitely is not. It may be giving the sort of a connection to gold, but they can't go back to a gold standard, because it would tie the hands of the monetary authorities in terms of financing the government. A great power, such as China or America, simply cannot afford to go back to a rigid monetary or digital standard. You simply can't do it. You couldn't fix the dollar to Bitcoin in the same way as you couldn't fix the yuan to gold. It would be impossible, because you'd lack, if you like, the ability to change fiscal policy, and that's what they need to do, particularly if we're in ever get to the stage of being in a kinetic war.
But there's also like a clear trend, right, of with the Shanghai Gold Exchange, for example, the push towards there also being able to build an infrastructure of vault nodes. The latest example was, for example, of Saudi Arabia, where they traded gold with gold, oil with gold. Um, do you think that this is also then one push further than to gain access and control over the pricing of gold itself, and getting away from the LBMA, for example?
Yes, I think absolutely, no question about that. I think China's trying to control the gold price, and they want to accumulate gold. And the unofficial estimates are that they've already accumulated, officially, this is about 5,000 tons of gold. Now, if you add in the Friends of China, so the Shanghai Cooperation Organization and the other BRICS, you're looking at a pool of gold which is far in excess of what America has in Fort Knox. So already they're way ahead, and therefore, it's in their interest to allow the gold price to go up. So I think they want to control it, for sure. But as I say, I mean, I think that would give China a lot more power, and the idea that they're using gold to exchange against commodities is pretty much telling us that's their intention. Now, even though they might allow Saudi Arabia to do a gold oil exchange. Okay, these are going to be very, very selective trades. Okay, but if you go back to the old gold exchange standard that was run by America up to 1971, we as individuals were never allowed to exchange our gold for $35 or whatever it was, or to buy gold at $35. We couldn't do that. Okay, only governments were allowed to do that. Okay, so there was a two-tier gold market. In the same way as there's a two-tier gold, there may well be a two-tier gold market here in terms of access to that. It may be only the Saudis or Brazil or whoever are allowed to make those trades. They won't allow individuals to do that. Certainly to take gold out of the economy. There's a free gold market in China, but you simply can't export gold.
True. So now, if like to wrap it up, if we look at now more like on the asset side and asset distribution, and take into consideration everything you've just mentioned earlier on, that would obviously have an impact on equities, and that would also obviously have an impact on Bitcoin and gold more particularly. How would you paint this picture now?
Okay, well, if you come back to this cycle that I showed earlier, so this is the global liquidity cycle. If you frame that schematically in this diagram, you can see there are four regimes on the left that we describe as liquidity regimes, investment regimes: calm, speculation, turbulence, rebound. The names are, pretty self-evident. And then you've got on the right-hand side the equivalent asset allocation cycle. So what that really says is that if you're in the upswing of the cycle, really between the rebound or through the rebound and calm phases, equities do well. Commodities tend to do well around the peak of the cycle, so between calm and speculation. Cash is very good on the way down when you're risk off, so speculation to turbulence. And then when you get into the sort of the deep turbulence area, you want government bonds, long duration government bonds, and that's really how the cycle evolves. Now, this traffic light system is telling us, how to invest, same information, but just in a different way. And what that's saying is that if you look at the left-hand side, that's asset allocation, and then right-hand side is industry groups. You've got four different regimes: rebound, calm, speculation, turbulence on each, and you've got different asset groupings as you go down the axis, or industry groups on the right. And what it says is that in rebound and calm, you want equities. In rebound, you want credits. You want to start taking down your credits in calm, top slicing. And then by speculation, you want to be getting out of credits. And I think we're in that speculation zone pretty much now. We're getting into that sort of area. So my view is you want to be top slicing equities. You want to be starting to get out of credits. You still want to be in commodities. And I still like gold, for example, precious metals, but I think other commodities like copper are still got legs in them, particularly if the US economy gets traction, as we suggest next year. Bond duration is a bit too early, but you could be putting a toe in the water, beginning to get back into bonds. And then if you look at industry groups, cyclicals look great on the way up, not so good on the liquidity cycle down. Technology has clearly been a leader. It's very good in rebound and calm. Financials come in through mid-cycle, and I think investors in Europe would have enjoyed a huge run in bank stocks in the last 12 months, and that's just quite normal for this stage of the cycle. And then you start to see areas like energy, commodities really picking up late in the cycle. And that's where I think we are now. I mean, you've had tremendous gains in mining stocks, for example. So, what I'm saying is that despite the fact that economists, well, not only don't have any data to work with at the moment for the US economy, but I mean, the economies have flatlined pretty much ever since COVID. There's been no discernible economic cycle. What we've had is an absolutely plain vanilla investment cycle here, moving through this asset allocation schema almost exactly, both in assets and in terms of industry groups. I mean, nothing could be more straightforward. It's all driven by the liquidity cycle, not by some notional economic cycle. And that's what I think it always is anyway. But, we can debate that one. I think we're in a later cycle speculative phase.
The
So
speculative phase.
I mean, if you look at this chart here, which is looking at global liquidity and world wealth, this is annual changes. The orange line is the global liquidity growth. Now, what I've done is project that over the next few months. But if you look more into 2026, that dotted line is going to come down. It's got a little bit of momentum near term, but you kind of get the idea that the black line will follow that. So I'm not saying, completely bail out of markets right now, but I think you've got to start thinking about 2026 being a less attractive year for sure. And if you start to look at more specific things like Bitcoin, this is looking at the correlation between Bitcoin and global liquidity weekly. Now, I showed earlier on a chart showing Fed liquidity and the S&P, which was about a 6-month lead time. This one is shorter between global liquidity and Bitcoin of about 13 weeks. But what it's saying is that, the black line is looking at liquidity. This is a very short-term indicator, but we would suspect that black line is going to start to flatline more and more over the course of 2026. It's possible it may even fall, and therefore the prospective gains in Bitcoin are not going to be there. However, and this is the however, which is always very difficult to time, on setbacks, I'd be a buyer. And, I think the trend in both gold and Bitcoin is really well established. I think you've got strong, compelling trends there because we're in a world of monetary inflation. And therefore, what you've got to do is to buy these things on dips. And a sort of a final comment is if you really want to look at the long term prospects, start to look. I'm going to show you an earlier chart. This chart is looking at the structural deficit in the US economy. Now, the structural deficit, the orange line, is shown as a percent of GDP. And that is basically careering towards levels of 10 to 12% of GDP each year by 2050. These are not our figures. They come from the Congressional Budget Office, which is a bipartisan body in the US. The only change we've made to those figures is we've put a slightly elevated number for defense spending at 5% of GDP because that's the NATO target. But otherwise, we take their numbers. And what you can see is the structural deficit, which is 4 items: Social Security spending, Medicare, the interest bill, and defense. No discretionary spending at all. That's what you get on the fiscal deficit. The dotted line is debt held by the public, which you can see on that right scale, balloons up to 250% of GDP by 2050. Now, the Congressional Budget Office has a similar projection of a very similar figure. So our numbers are not out of line. What does that mean? Well, this chart is saying, look, let's just make an assumption here. And let's make an assumption that the gold value of US government debt does not change from now until 2050. What would the gold price have to be to match that increase in debt? And what you see there is the implied gold price. Now, that means that gold hits 10,000 by the mid 2030s and prospectively could get to $25,000 an ounce by 2050. Okay. There are two things to bear in mind when you look at this. Number one, the long-term ratio between Bitcoin and gold seems to be about 28 times. Okay. And that's, that may be a trading rule, but it's not a bad long-term rule. Okay. To think about. Okay. So you could be, easily thinking of huge inflation in Bitcoin prices over the long term. The second thing to say is that if people think this is fanciful, think what happened in the last 25 years. The stock of US debt went up 10 times, right? From year 2000 to year 2025, a tenfold increase in federal government debt. That's eye-watering. The S&P over that same time frame went up barely 5 times, okay? Gold prices have gone up 13 times. So gold has more than matched the increase in federal debt. And we're just saying, let's assume it matches the increase in federal debt. So that is where the long-term future is. You've got to have monetary inflation hedges because we're in a fiat world. And we're in a fiat world until we're not, but at the moment we're in a fiat world. And to get out of a fiat world, you'd have to have really huge austerity from governments and no prospect of heightened military tensions. I don't
Mm.
think we've got either.
So, bottom line is in this kind of setup, gold and Bitcoin are the things to hold on a fundamental long-term perspective.
For the
That's
long
the
term, for younger generations, this is what you got to invest in my view. Okay, if you're older like me, you can fine tune it, but I think generally you just got to buy these things on weakness year after year.
This is pretty clear. But for example, Francis Hunt made an argument that now gold is only catching up to the whole money supply that's been pumped also before the 2000s, that only now is entering a certain convexity and parabolic acceleration phase. But in your chart, it's kind of superposed. So you do not take into consideration what preceded that period, or is that
Well, I mean,
delay?
because I think that what we have is what we've got, and I'm starting from this point, and you've also got to take into account the fact that policymakers are mischievous, and it's not in their interests to allow the gold price to go up to this extent. In the same way, as I've tried to say, there's sort of competition here. So there have been many attempts before to try and try and undermine the gold market, whether it's short selling by bullion banks or whatever it may be. There are a lot of constraints on the free movement or free pricing of gold. So let's not rule that out. But I think generally, I'd be comfortable for where we are now of seeing, this sort of escalation in the gold price. I mean, if it's more than that, great. I'll come along quietly, but I think we're going to get decent gains anyway. I mean, it's an
Yeah.
asset which is likely to outperform the stock markets considerably.
So in that sense, it would also leave equities more like moving at least sideways for the time being, if not totally
Well,
in
I
the
think
gutter.
let's get the perspective. I think over the next 12 months, I think I would at best see a range bound equity market. And we know that, equity markets tend not to stand still. So there's clearly downside risks, particularly if policymakers make mistakes. So that I think is clear. In the longer term, because equities are a liquidity sensitive asset too, and I'm suggesting we need lots of liquidity because we've got lots of debt, whether we like it or not, and that debt is growing exponentially. We're going to be in a world where there's a lot more liquidity, and therefore equity prices will go up. Bonds will be, uh, you know, will lose their value. I'm not keen on bond markets apart from a very short-term defensive move. But I think bonds in the long term are not. And maybe this is the wrong analogy, but it's an analogy that is extremely apt. Is look at what happened in Germany after World War One with hyperinflation. Uh, you had a situation there where if you were a bondholder, you lost almost all your wealth, and that tended to be the middle classes, and particularly the older generations. They lost most of their wealth. And who gained from that period, because it was clearly an income redistribution, it tended to be the younger generations who, despite the fact their peers and their parents said, or rather their parents and grandparents said, don't invest in equities. These are crazy investments, okay? Go for the safety of German government bonds because they've always paid out. That was such a bad investment recommendation, but it draws a parallel with what's happening now. And people are saying don't invest in Bitcoin or cryptocurrencies because these are crazy investments. Nonetheless, they've done extremely well, and they seem to be inflation proof. And that's the parallel I would draw. Now, I'd stop there because there are a lot of unfortunate analogies if you start to extrapolate that German experience. But the fact is, that you see these huge differentials in asset performance during high inflation periods. And that's what we're likely to see. Equities will do pretty well in a high inflation period. I'm not suggesting we're in a hyperinflation, but we're clearly treading down the road of more inflation. Equities do well, large cap equities will do well, but other assets will do a lot better. And I think Bitcoin and gold are the things you want to own.
Beautiful conclusion, Michael. Thanks a lot for this precious knowledge and unpacking all those complex topics. Um, as a lot of people know, but those who don't know, you also have a Substack to which you provide more and more analysis. Also for people who want to dig deeper into your articles and your work. You also have a website and an X account that will link everything down in the description below.
Brilliant.
Again, Michael, thanks a lot.
Great pleasure. Thanks so much.